Welcome to everyone. This week video will introduce the concept of dual analysis in the gold market. As usually, before we start, make sure you read carefully the disclaimer. In this video we will dive into different topics like the overview of dual analysis, the concept of dual analysis, the lows and peaks analysis, and more. At the end of this video, you will be able to know how to use the dual analysis in your trading decisions for the gold market in order to have a better trading and risks management. The dual analysis is an important part in the Hurst principle in the gold market. Let's start with an overview of dual analysis. In fact, the gold market analysis is sometimes more precise by using the troughs or lows analysis and sometimes using the peaks analysis. Dual analysis in gold trading combines both peaks analysis and lows analysis. The gold dual analysis in the Hurst world involves combinedly analyzing not only supply, demand, geopolitical factors affecting gold prices, but also using the Hurst nominal cyclic model to predict future price movements. The price of gold is influenced by various factors such as inflation rates, currency fluctuations, geopolitical events, and investor sentiment. Gold is often seen as a safe haven asset during times of economic uncertainty, making it a popular choice for diversifying portfolios and hedging against market risks. To have a better understanding, I recommend at the end of this video to read my series of articles on the Hurst principle on my website, tradingmarketcycles.com. This include the identification of dominant cycles in price movements, understanding the phasing of cycles to predict turning points. By applying Hurst's principles, traders can gain a deeper insight into market cycles and improve their trading strategies and better risk management. Concept of dual analysis in gold market. The concept of dual analysis in the gold market represents a sophisticated approach to market analysis that extends beyond traditional cyclic analysis methods. Based on Hurst's principles, this methodology involves analyzing both market peaks and troughs simultaneously, providing traders with a more comprehensive understanding of market movements. Understanding dual analysis versus traditional cycle troughs analysis. The traditional cycle analysis, as initially proposed by Hurst, primarily focused on analyzing cycle troughs, or lows, to identify market patterns. This approach was based on the observation that troughs tend to be more precise and easier to identify than peaks. However, dual analysis takes this foundation and expands it by incorporating peak analysis, creating a more robust analytical framework. Components of dual analysis in gold markets: the trough analysis. Identifying the support levels. This looks for prices where gold tends to stop falling and starts rising again. These are support levels. B. Measures buying pressure. It assesses how strong the demand is for gold when prices reach these low points. C. Determines cycle lengths from low to low. It tracks how long it for gold prices to move from one low point to the next. D. Establishes baseline cycles. This sets a standard for how these price movements usually happen over time. At the bottom of the chart, the green sine waves indicate the 20-week cycle, and the blue sine waves represent the 40-week cycle in the gold market. Just below the chart lows, the small green horizontal lines denote the lows and potential support points of the 20-week cycle. The short blue lines show the times when we expect support points for the 40-week cycle. Peak analysis. Identifying the resistance levels. This finds prices where gold usually stops rising and starts to fall. These are resistance levels. A. By measuring selling pressure. It looks at how strong the supply is when prices reach these high points. B. Determines cycle lengths from high to high. It tracks how long it takes for gold prices to move from one high point to the next. C. Validates cycle translation. This checks if the patterns observed in price movements are consistent and reliable over time. In summary, trough analysis focuses on lows and buying behavior, while peak analysis focuses on highs and selling behavior in the gold market. At the top of the chart, the green sine waves indicate the 20-week cycle, and the purple sine waves represent the 40-week cycle in the gold market. Just below them, the small green horizontal lines denote the peak and resistance points of the 20-week cycle. The short purple lines show the times when we expect resistance points for the 40-week cycle. Why dual analysis is particularly effective in gold markets. Gold markets exhibit unique characteristics that make dual analysis especially valuable. Market structure, the multiple timeframe influences. The gold market operates across various timeframes, which means that trends can appear differently, depending on whether you're looking at a 1-minute chart or a monthly chart. Strong correlation with economic factors. Gold prices are significantly influenced by economic indicators, such as inflation rates, interest rates, and currency strength, especially the US dollar. For example, when inflation rises, investors often flock to gold as a hedge, driving prices up. Similarly, lower interest rates tend to weaken the dollar, making gold more attractive to international buyers. Tendency to form clear peaks and troughs. The gold market's price movements often create identifiable peaks, high points, and troughs, low points. These formations can signal potential reversal points. For instance, after a prolonged increase in price, a peak may indicate that the market is becoming overbought, leading to a potential correction. Conversely, during periods of panic buying or fear, prices may spike sharply, creating a peak that traders can recognize and use for the peak analysis. Identifying these points is crucial for making informed trading decisions. The cyclical nature. There is 3 different cyclical nature pattern. The first one is the regular cyclic patterns. The gold market tends to exhibit cyclical behavior, often influenced by recurring patterns in economic conditions and investor sentiment. The second one, the clear seasonal influences. Certain times of the year see increased demand for gold, such as during cultural festivals, wedding seasons, or holidays. For instance, in countries like India, demand for gold surges during Diwali, driving prices up. By understanding these seasonal trends, traders can position themselves to capitalize on expected price increases or decreases. And the third one is the strong harmonic relationships. Gold often displays harmonic relationships with other assets, such as stocks, bonds, and currencies. For instance, sometime a drop in stock prices might lead investors to turn to gold as a safe haven, creating a correlation between the two. Traders can analyze these relationships to predict how gold might react to changes in other markets, enhancing their overall trading strategy. In summary, a deeper understanding of the market structure and cyclical nature of gold can significantly improve trading outcomes. Switching between low and peak analysis. When analyzing gold prices, knowing when to switch between examining low points, buying opportunities, and peak points, selling opportunities, is crucial. Here are key considerations. The best times to switch to peak analysis. During strong uptrends, the market makes consistent higher highs. This means that the price of gold is repeatedly reaching new highs. When you see this pattern, it's a sign the market is strong, and the most important one is very difficult to identify the cycle lows, because the gold market is excessively bullish. Then switching to the peak analysis can solve the issue. When the momentum indicators suggest overbought conditions. These are traditional technical analysis tools that show whether gold is too expensive right now. If these indicators signal that gold is overbought, it could be a good time to shift to peak analysis. We will see the different technical analysis tools in another video. During high volatility and upward movements. If prices are jumping around a lot but mostly going up, it indicates excitement in the market, and it may be time to analyze where the price might stop rising. The best times to switch to trough analysis. During the uptrends, the market makes higher highs with troughs that are easier to identify than peaks. This means that the price of gold is consistently reaching new highs. But some investors are taking profits, and some selling pressure is starting to emerge. When you observe this pattern, it is a sign that the market is strong, but not strong enough to form very clear peaks. Instead, the market forms what is known as rounded tops. During the downtrends. When the price of gold keeps making lower lows, it indicates a downtrend. Because the lows are very easy to identify, this is a sign to start looking for troughs. When the momentum indicators suggest oversold conditions. If indicators show that gold is too cheap, it might be a good time to analyze potential buying opportunities. When there is high volatility in downward movements. If prices are dropping suddenly and sharply, it indicates uncertainty and may signal a bottoming out. Technical considerations. Formation of clear support levels. These are price points where gold tends to stop falling and starts to rise again. Identifying these levels is crucial for trough analysis. Positive divergence in momentum indicators. This is when prices are falling, but momentum indicators show signs of increasing strength. It could mean that a reversal is coming. Volume analysis showing potential bottom formation. If trading volume increases while prices are low, it might indicate that buyers are stepping in, signaling a potential bottom. In summary, switching between low and peak analysis depends on observing price trends, market indicators, and historical patterns. Understanding these factors helps traders make informed decisions about when to buy or sell gold. Since the dual analysis is a vast subject, in order to make this video relatively short, I suggest for a deeper analysis on dual analysis, to go to my website, tradingmarketcycles.com. On my website, I explain in greater details the advantage of using the dual analysis in gold market. In conclusion, the dual analysis represents a significant advancement in cyclic analysis methodology. By incorporating both peak and trough analysis in gold market, traders can develop a more comprehensive understanding of gold market movements. The key to success lies in understanding when to switch between analyses and how to integrate both perspectives into a cohesive trading approach. This methodology, while more complex than traditional cycle analysis, offers superior insights into market behavior and potentially better trading results. If you like this video, please share this video with your friends. Click on the like button and subscribe to make sure you won't miss any video and to support my channel. Thank you. This is the end of this week's video. Thank you to follow me and see you next week for a new video.